In this video, we're going to talk about Bollinger Bands. But before we get into a discussion of Bollinger Bands, it's first important to reinforce some basic guidelines needed to locate trading opportunities. First, following these guidelines should make it easier for you to locate trading opportunities in general. But second, you'll also more clearly understand why traders even care to use tools like Bollinger Bands in their trading. So let's get started. When identifying trading opportunities, we recommend that traders follow two basic guidelines. First, we recommend that you identify the direction of the trend. If the market is trending up, we recommend looking for buying opportunities. If the market is trending down, we recommend looking for selling opportunities. This guideline is arguably much easier to abide by than the second guideline, but even still, it's often neglected, and we highly recommend that you closely adhere to this first guideline. When you follow it, the rest of your trading approach often falls right into place, and you often increase your long-term chance of success. The second guideline to identifying trading opportunities is to identify the right times to buy and to sell. This may seem a bit obvious, but it's true. Knowing when to buy and when to sell is very important. This step is often much more challenging than locating the direction of the trend, but there are many technical tools that a trader can use to assist them with recognizing when to buy and when to sell. And we're going to focus on one of those technical tools in this video, which is Bollinger Bands. Bollinger Bands is a technical indicator that utilizes a combination of simple moving averages which can help a trader compare volatility and relative price levels over a period of time. The outer bands that you can see here and here are often used to help traders time an entry or exit point for a trade. The default settings in most charting packages will have the outer bands 2 standard deviations away from the 20-period simple moving average line found here in the middle. To increase the reliability of the signals, we recommend changing the setting to 3 standard deviations, which can be done from the Parameters tab of the Indicator Properties window within the MarketScope 2.0 charting package. Standard deviation is a calculation used in statistics to measure volatility. Therefore, as price action approaches the outer bands, which can be considered more extreme price levels, traders often anticipate that price action will reverse around these extremes and move back towards more natural levels. Thus, the outer bands are often used to identify entry and exit points. Now that you have a basic idea of what Bollinger Bands are and how you can use them in your trading, let's take a look at some specific trading setups to get a better feel for how to best use Bollinger Bands. Let's first look at a potential buying setup. As we previously mentioned, our first step is to recognize the direction of the trend. From this daily chart, it's quite clear that the market is in an uptrend. Therefore, we're only going to be looking for buying opportunities. There may be times when a short-term selling opportunity arises, but the odds just aren't in our favor, and we truly recommend sticking to the phrase, "The trend is your friend." You can see here that the market has moved down to touch the lower Bollinger Band. Again, this lower Bollinger Band is an extreme price level, so we're looking to buy on a reversal back to the upside. But we don't want to buy the moment the price action touches the band. To increase the reliability of the signal, we want to wait for a blue candle to appear to note that there are buyers coming back into the market. It's also important to wait for the candle to close before acting, as there can be times that the candle can appear blue only to close lower and be printed as a red candle. So we wait for the candle to close blue to confirm that the closing price is higher than the opening price, which is what identifies the candle as blue. Then, our buy will be at the open of the next candle. Since we waited to buy after a bounce back off of a low, we can identify that low as possible support and can place our protective stop a few pips below the low. If the market reverses back to the downside and prints another low, we won't want to stay in the trade, and our protective stop placed below the low will help us in this regard. We can use the same thought process when looking for selling opportunities. Again, because we're working off of a daily chart, we can confidently say that the market is in a downtrend. Because we're looking for selling opportunities, we want to watch for the market to move up to touch the upper Bollinger Band. We then want to wait for a red candle to note that there are sellers coming back into the market. We also want to wait for the candle to close red to confirm that the closing price is lower than the opening price, which is what identifies the candle as red. Our sell will then be at the open of the next candle. Since we waited to sell after a bounce back down off of a high, we can identify that high as possible resistance. That means that we can place our protective stop a few pips above the high, as we would not want to be in a sell trade if the market reverses back to the upside and prints a new high. We've just discussed how traders often use Bollinger Bands to help time an entry and exit after the market price reverses back in the direction of the trend. But traders also use Bollinger Bands to note a potential breakout situation. As the market trades in a range-bound situation, the bands will move closer together. The closer they print, the more likelihood of a breakout. While this indicator does not tell us the direction of the breakout, just being aware of the possibility can help a trader. So let's take a look at an example. Here we see where the Bollinger Bands were moving closer together and the market was in a range. While some traders may have assumed the range would last for a long time, traders noting the situation with Bollinger Bands were well aware of the potential breakout at any time. In these types of situations, it's often not easy to determine which direction the market will break out, to the upside or to the downside. So a common strategy will be to place entry orders above the range and below the range, and allow the market to determine which trade to take. With the breakout, we can see where the bands moved far apart, which is an indication of increased volatility. While this indicator can work on any time frame, like all technical analysis, the daily chart will typically offer the better trading opportunities, with the shorter term charts offering more opportunities. It's up to each trader to find the balance between solid opportunities and the number of trades they wish to take advantage of in their approach. But the key is, as always, to trade with the trend and not against it.